Again, this is Ismael Ray Reyes, and I just want to welcome everyone to the Greater Central Florida Multifamily Investor Group meeting for February. Focus here is really to learn from each other, connect with each other, and the focus is Florida, but not so much just investing or doing stuff in Florida, but connecting with other Floridians that may be looking elsewhere. So there's a nexus outside of Florida, I believe, because I mean, there are other great markets. Winston can attest that, we do invest in other places, and sometimes the competition is so fierce in certain markets that it almost makes sense to invest where it makes sense. So Rachel is the Director of Client Services at Solo401k.com and Nabers Group. She joined Nabers Group in early 2011 and quickly discovered her passion for empowering entrepreneurs to live their best life. Nabers Group was the very first non-custodial document provider in the industry and has helped thousands of self-directed investors take control of their retirement future. And I would say that I have my Solo 401k with Nabers Group, Solo 401k. So this is not just preaching to the choir. I firmly believe, and I did my research, that they have a great team. And so with that, Rachel, I'll turn it over to you.
Right on. Thanks. Thanks for having me, Ray, and hello, everybody. I have to say, it's always a little bit weird when you hear your own bio being read about you when you're right there. So we'll just pretend like, thank you, but it's also weird. And just, hi, how are you? I'm Rachel. I'm Rachel Nabers with Nabers Group and Solo401k.com. And what I wanted to talk to you guys about this evening, I have a little slideshow for you, is how to tap into your retirement funds to invest in real estate. So a lot of people don't know that they can use their IRAs and their 401ks to get into deals. And there's a lot of money that you could be potentially just leaving on the table if you're not tapping into your IRA or your 401k. So let me go ahead and share my screen. Give me one moment here. All right, should be able to see that now. So yeah, we're going to talk about how to invest your retirement funds into real estate. And of course, a disclaimer as we get started, just because we're talking about retirement funds, I'm not magically becoming your CPA or attorney. I'm not here to compliance or due diligence deals, but I do want to talk to you about the structure of how it works to use your IRA and your 401k to invest in real estate. So a lot of this stuff you guys are already going to know. This is sort of preaching to the choir a bit. You already believe in real estate, and a lot of self-directed investors in the retirement space have believed in real estate and loved it too for a really long time. These are probably some reasons why you like real estate. It's tangible, it produces yield, it can appreciate and protect against inflation. So you can invest your retirement funds into real estate deals, including single families, REITs, syndications, and we're going to talk about how to make that happen. We're going to cover two structures on today's presentation, the Solo 401k and the Checkbook IRA. We'll cover similarities, differences, who qualifies for what, how each one works. And this webinar really is meant to be an introduction. It's not a comprehensive training. We're not going to go over every single little detail of IRAs and 401ks and the Internal Revenue Code. What I want to do is plant some seeds so that you can start to think about how to utilize your retirement funds to invest in real estate. And also for cap raisers. So if you're raising capital, this can be a very interesting way to raise more capital faster, because your investors don't always know that they can use their retirement funds to invest in as LPs in your deal. So if you have retirement funds that you can leverage into deals, that's wonderful. And if you're a cap raiser, then this can be a really nice feather in your cap of how to raise more money faster. So we want to introduce you to the power of controlling your own retirement funds so you can invest in what you want. We're really big into freedom and independence and you being able to control your own money. And I do feel free to post any questions in the chat as we continue. I'm going to hold those questions till the end because we will get through the presentation. There might be a lot of the questions that are answered, but feel free to type those questions into the chat. And then at the end of the presentation, we'll go through everything and we'll answer as many questions as we can. And if you want to discuss your unique situation, we have a link at the end so you can sign up for a free consultation. Just to give you a little bit of background about us, we launched the IRA LLC, also known as the Checkbook IRA, in 2003 and Solo401k.com in 2006. We've had consistent IRS document approval that entire time. and help thousands of self-directed investors take control of their retirement funds. So every team member at Nabers Group has and invests with their own checkbook control retirement plan. I'm a real estate investor. I also use my own 401k to invest in properties. Our team works closely with the IRS and the DOL, that's the Department of Labor, to ensure that your documents are updated on time and we get the most up-to-date compliance direct from the source. So we do all the boring stuff. We are your paperwork people so that you can focus on finding deals to invest in or getting the funds raised if you're going to be a GP on a deal. Just to give you a little bit of background on the solo 401k, it's also known as a one participant plan. You can see that this page comes literally directly from the IRS website. So even though you might not have heard of the solo 401k before, it is a legit structure blessed by the IRS. And the IRS puts out a public list of all of their approved document providers, and we are on that list. We specialize in checkbook control. We are not a custodian. We never touch your money. You're in charge of your own money the entire time. Like I said, we're the paperwork people. You're in charge of your retirement funds and how they're invested. And you can invest in any number of alternative assets with a solo 401k and a checkbook IRA, including real estate, single family, multifamily, syndications, commercial properties, private equity deals, mortgage notes. I know one of you said you're a hard money lender. The 401k can be a lender as well. You can invest in tax liens, tax deeds, REITs, in addition to, stocks, bonds, funds, Bitcoin, gold, silver, all of that's on the table with your retirement account. If we look over the flow of how it works to get your retirement funds into your control, it's a pretty straightforward process. We'll do a lot of the boring stuff on the back end. You'll establish your account, and our team will help you determine which account might be the right fit for you, if it's a solo 401k or a checkbook IRA. Once you've got that structure established, the next thing to do is fund the account. Typically, the money is going to come in from rollovers from another retirement plan, or you can make contributions. Once your account is set up and funded, the next step is to choose your deals. And as we covered, your retirement account can invest in pretty much anything that you want. And the final step is to deploy those funds and begin investing. So the first thing that we're going to talk about is the solo 401k. First of all, what is a solo 401k? A solo 401k is a company retirement plan. It's also known as a qualified retirement plan, or an employer-sponsored plan, or maybe just a 401k. All companies, all 401ks have a sponsoring company. So anybody can have an IRA, it's for individuals. Solo 401ks are for businesses. And a solo 401k is specifically designed for a small business. To qualify for a solo 401k, you have to have two things. You need the presence of self-employment business activity, and you need the absence of full-time employees in that business other than you and your spouse. Part-time employees are okay. Independent contractors in your small business are okay. Your small business structure can be anything, including sole proprietorship, single member LLCs, multi-member LLCs, S Corps, C Corps, partnerships. We work with a lot of real estate agents who receive 1099 income as a sole proprietor or an independent contractor. That qualifies you for having a solo 401k plan. Working full-time in your own small business is awesome. Every owner-only business should have a solo 401k to get the most out of the tax benefits available for you. And if you have a normal full-time job in addition to your own small business, that's okay too. Working on your small business part-time or on the side is okay. We don't have any minimum number of hours that you have to work in your small business in order to qualify for the solo 401k plan. It's okay to have a normal job in addition to having a small business on the side to qualify for your solo 401k. You can have a 401k at your day job and have your solo 401k at the same time. It's acceptable to have and contribute to two different company 401k plans, even at the same time. So if you have a normal day job and you're contributing to your 401k at work, then we can set up a solo 401k for your small business or your side hustle or whatever it is that you're doing. And that way you can put money in your solo 401k and continue to contribute to your workplace 401k. Some common business examples to qualify for the solo 401k, as I mentioned: realtors, attorneys, CPAs, software developers, consultants, writers, Amazon resellers, bloggers, hairdressers. Really, if you have your own self-employment activity and you're making a little bit of money on your own business, then you can qualify for a solo 401k. And of course, if you have a full-fledged small business that's already running, you definitely need to be thinking about this, because there's huge tax advantages to the solo 401k. Chances are, if you have a successful small business and you're a high earner, you're wasting money not putting enough away into a tax advantage structure. So the solo 401k is really something to seriously consider. Qualifying business can even include part-time stuff like driving Uber or Lyft, or maybe a job that you work on the weekends or in the evenings. And earning 1099 income is a qualifier. Now let's talk about how to fund your solo 401k. You can fund a solo 401k in one of two ways: rollovers from another retirement plan and contributions from your business earnings. So when your small business makes money, you can put some of that money into your company 401k plan, which is your solo 401k. First, we'll talk about rollovers. So the solo 401k, as you saw from the IRS website, it's just a 401k like any other. So you can roll in money from pretty much anywhere: IRAs, other 401ks, 403bs, TSPs. I know we have some retired military here. So if you have a TSP plan, you can roll those funds into a solo 401k, then leverage those into real estate deals, pension plans. These are not taxable distributions. We're keeping things nice and boring with the IRS. We're moving from one retirement plan to another. So this is not a taxable distribution. There should be no taxable consequences, and our team will help you through this rollover. The only account you cannot roll into a solo 401k is a Roth IRA. Roth 401k is okay, but Roth IRA is off limits. If you have the majority of your assets in a Roth IRA, then you'll want to pay attention a little bit later when we discuss the checkbook IRA structure. So a little visual about how rollovers work. Let's say you've got a rollover IRA somewhere and you've got a previous employer 401k. A nice thing about the solo 401k is it can help you to consolidate those assets, which gives you a bigger pool of investment to draw from. That way you can leverage those assets into deals. And if your small business is making profit, you can contribute some of that money into the solo 401k. Contributions can be pre-tax, that means they're tax deductible, or after tax. Our solo 401k automatically includes a Roth 401k built right in from the get-go. It's not a separate account you have to sign up for or anything like that. It's automatically included in your solo 401k. You get pre-tax and Roth included. And you can make contributions of up to $64,500 per year. I did not misspeak. You can put $64,000 into a solo 401k every single year, double that if you're married, and that can be a tax deduction. So that's why I was saying earlier, if you're a high earner, if your business is generating strong income, then you have the ability to shelter over 60 grand every year. That means you put it into a retirement plan. Now that money does not count for income taxes. It goes right into a tax deferred retirement plan, or tax-free if you're utilizing the Roth option. And then you can continue to leverage those assets into investments like real estate or syndications, where you're then able to grow all that money tax-free. So hopefully you can start to see there's this infinite loop of awesomeness where your business is making money, you're putting that money away, it's a tax deduction. Now you're paying less in taxes. Once the money's in the 401k plan, you can be using that to invest, and all of those gains and distributions and dividends are growing tax deferred or tax free. So it's a really big deal. If we're adding to the money pile in the solo 401k, we've already gone through those rollovers. When your business makes money, you also contribute that into the solo 401k. So then what happens is, let's say that you find a syndication you want to invest in and you want your 401k to be an LP. And we'll go through sort of the mechanics of a deal structure in just a moment. It really is as simple as sending a wire from your bank account or your brokerage account for the 401k to the closing table to the investment sponsor, and then your 401k is the investor, in the single family deal, in the syndication, becomes an LP, et cetera. So that property or the shares in the LLC become an asset of your 401k plan. And we'll go through that deal structure in just a moment. Now, I know that there's probably some of you that don't qualify for a solo 401k. So maybe you don't have a business, you don't have any self-employment activity, or maybe you do have a business and you're not eligible because your business already has full-time W-2 employees other than you or your spouse. Remember, those are the qualifiers for a solo 401k. It's meant for owner-only businesses. So if you have your own small business, you're working in your own business, maybe your spouse works for you, it's okay for you to have a solo 401k. If you have a business that has full-time W-2 employees, that disqualifies you from a solo 401k plan. And in that instance, you want to look at a checkbook IRA LLC. This is just like the solo 401k with respect to being a checkbook controlled plan. You're not handing your money over to a custodian or anyone else. You get to be in direct control of your assets. And what that means is that literally with a solo 401k, you have a bank account and your 401k money is in there and you get to decide and execute on those investments. Similarly, with the checkbook IRA LLC, the money will end up in an account that you control, a bank account. And that way you can begin investing those funds in investments that you choose. With a checkbook IRA, you can have it be a traditional IRA or a Roth IRA. Don't combine both types of pre and after tax in one account. That's not allowed. So you would choose, okay, I've got the majority of my money in a traditional IRA. I don't qualify for a solo 401k. In that instance, we would set up a checkbook IRA for you. Remember earlier, I said if most of your money is in a Roth IRA, Roth IRAs cannot roll into a Roth 401k. It's a weird IRS rule. If the majority of your assets are in a Roth IRA, then you want to consider the checkbook IRA structure. So the checkbook IRA is composed of two component parts. There's a self-directed IRA and there's a special purpose LLC. The self-directed IRA is pretty normal and standard. It has to be with a custodian that's willing to invest in an LLC. So Fidelity, Schwab, E-Trade, TD Ameritrade, they're not going to work. But there's plenty of self-directed IRA custodians that are happy to do this type of structure. We have a few that we work with. And the real special part of the checkbook IRA, what gives it the checkbook, is something called a special purpose LLC. This LLC is not a business. It is an asset of your 401k plan. If you formed LLCs before, which you might have if you're a syndicator, then you'll know that LLCs generally have two roles to them. There's a member, that's who puts in money, and there's a manager. That's who controls where the money is invested or directed. With a checkbook IRA, the member is your IRA and you are the manager. So that's how you get the checkbook control. The IRA money literally ends up into an LLC bank account that you control, and then you're able to invest those funds. So if we take a look at the money flow in an IRA LLC, we've set up, let's say in this example, we've created an IRA LLC for you. So there's those two parts, right? In the middle, there's the self-directed IRA and that new special purpose LLC. And just to answer a question in advance that some of you are probably already thinking in your mind, you cannot use an LLC that's already in existence. So if you have an old LLC that you haven't really used, or you just set one up, you can't use those. It's like a chicken and the egg situation. The IRA has to come first, and then we form the LLC after. So you can't use a pre-existing LLC. This is a brand new special purpose LLC. And we'll help you do the rollover from the old retirement plan into the new IRA. Again, funds can come from 401ks, TSPs, 457s, KEOGs, other IRAs. Anything can roll into an IRA. It's pretty straightforward. You just need to go like to like. So pre-tax 401k, pre-tax IRA goes into a pre-tax or traditional IRA. Roth 401k, Roth IRA, Roth 457 can go into Roth IRA. Similar tax classifications. Then that money goes from the IRA, after you roll it over from the old IRA to the new IRA, the custodians we work with automatically put the IRA money into the LLC bank account that you control. So once you've got the money in the LLC bank account, then it's really similar to what you did with the solo 401k. You find a property or a syndication you want to invest in, you send a wire or write a check from your LLC bank account, and your LLC then becomes the investor. Our team's going to handle everything. We'll establish the new IRA, we'll form the LLC, we help open the bank account for your LLC, and we help get your IRA funds invested into the LLC so you have total checkbook control. Let's walk through an example deal of a syndication. So let's say that you want to invest in a deal. In this case, we're looking at your 401k or your IRA as a potential LP. I'm not talking about you being a GP. I'm talking about you being a limited partner. So that's leveraging your retirement funds to invest as a passive investor into a syndication. If you're a cap raiser, then what you want to imagine here is what your investors will go through if they are leveraging their funds to get into your deal. So let's say you want to invest in a deal as an LP, or you're a syndicator, so you want to imagine what your LPs will go through. In this example, the investment is 100 grand, and we're going to look at David Jones. He'd like to use his solo 401k to become an LP. So he's got this funded solo 401k. Maybe he brought over some money from old IRAs, maybe an old TSP, and he's doing some work on the side as a consultant. So he's also making money in his business. So he's able to add to the 401k every year. David's solo 401k is called Jones Investment Trust. He chose that name. You get to choose whatever name you want for the trust. As the trustee for Jones Investment Trust, David invests $100,000. So remember, that's that checkbook control. David is in charge of his own money. The 401k funds end up in a bank account that David controls as the plan trustee. So David identifies that investment, and then David signs the paperwork as the trustee and wires the funds. The subscription agreement and the private placement memorandum are titled in the name of the Jones Investment Trust. In this example, David's 401k, Jones Investment Trust, is the investor. So David is not the investor. His 401k is the investor, and he's signing the investment paperwork as the trustee. So just, to kind of cap that visual, David can send that wire from his 401k bank account, and then the subscription document and the PPM are titled in the name of his trust. His trust is who is the investor. Then every month or quarter, whenever the syndicator is releasing distributions, that money comes right back into David's 401k trust. That way he's not paying taxes on any of those gains. It's an asset owned by the 401k, and the investment returns go back into the 401k. As distribution checks begin to come in, the funds are deposited right into Jones Investment Trust. The investment sponsor will issue a K-1 at the end of the year, and the K-1 will include the 401k trust name and tax ID number. We get a tax ID number for your 401k as a part of your solo 401k setup. So when you're doing any investing, you're going to list the 401k tax ID number on all of the investment paperwork. The 401k tax ID number is what's on the 401k bank account. This tells the IRS, hey, stay away from this money. It's 401k money. So even though you get a K-1, the IRS does not expect a tax return, because when we get that tax ID number in the beginning, we tell the IRS this is owned by a 401k plan. So any investment returns or K-1s or 1099s will not have a companion tax return because the owner is a 401k. Now, whenever I talk to real estate people, and I'm a real estate investor too, we have to talk about rules, because real estate people tend to try to be very creative in the way that they do things. And when it comes to the IRS, we don't want to be creative. We want to be boring. So don't break the rules. There are rules when it comes to your retirement money. I mean, if it was a free-for-all, most people would be bad at it and they would waste their money, and then that defeats the whole purpose of a retirement account. Remember, the point of a retirement plan is so that the IRS does not have a bunch of senior citizens needing government assistance. That's what they're trying to avoid. So they want people to have retirement plans. They put up rules and boundaries of how those funds can be invested. The biggest rule for real estate investors to be aware of is never mix personal and retirement funds in one deal. The most common question I get from syndicators is, can I have my 401k be, the GP? Or if I'm trying to get funds in as the general partner of a deal, can I put in some money in my 401k, put in some money? That way, when I'm earning the fees on the deals, those are all going in the 401k. You can't do that. So the 401k and the IRA, they're meant to be passive. The IRS lets all this money grow tax-free or tax-deferred because it's not a business. If you're running your 401k or your IRA like a business, the IRS is going to charge you income taxes, and that defeats the whole purpose of having an IRA and a 401k. So choose your deals wisely when it comes to how you're going to deploy your retirement funds. That's why I'm not talking to you with your syndicator cap on. I'm talking to you as an LP, or if you are a cap raiser, what you want your LPs to be thinking of. Retirement account investments are meant to be passive. So your 401k cannot be a GP on a deal, but your 401k can be an LP, but not on the same deal. So if your 401k money is in a deal, you aren't. If you are the GP on a deal, your 401k cannot be an LP on the same deal. Your 401k can be an LP on another deal, on a friend's deal, but you have to maintain separation. If your spouse is a GP, your 401k cannot be an LP in your spouse's deal because the IRS considers you one tax-paying entity. So you really want to make sure that you're maintaining separation between your personal involvement and your retirement account involvement. If you're a cap raiser and you have investors that are coming to you and they want to leverage their retirement funds into your deal, and let's say you have a $100,000 minimum for an investment and they don't have that much in the 401k. Let's say they have 75 grand in the solo 401k or an IRA LLC. They can't just put an extra 25 grand into their retirement account to meet the 100K minimum. What most attorneys will recommend is that you temporarily waive the minimum, but allow for 2 investors. If you have to talk to your counsel to see how many spots you have available, investor spots, etc. But what you could potentially do is accept the 75K from the IRA or the 401k from this investor, and then accept an additional 25K, but it's a second investor slot. So it's 2 sets of investment documents, 2 subscription documents, 2 private placement memorandums, 2 capital accounts, 2 investor accounts. That way, the investor is not commingling personal and retirement funds, and so they're not causing a prohibited transaction. That's maybe more a little bit in the weeds than you kind of thought we were going to get into, but when I'm talking to a bunch of deal makers, I want to make sure you guys understand some of the mechanics about this. So just a little bit more.
That is fantastic, Rachel.
Thank you. So just a little bit more about us. We'll cover cost and things, and then we'll jump into some questions. As an IRS approved document provider, it's our job to ensure your retirement plan documents are updated with the latest document releases from the IRS. Like I said, we do all the boring stuff. The IRS is going to make you change your retirement plan every single year. If you have like a company 401k right now, you don't feel that because there's a plan administrator and a plan document provider already doing that behind the scenes for you. But with checkbook control, nobody's in charge of your money except you. So you have to have someone on the paperwork side of things, making sure that somebody is talking to the IRS, getting the amendments, getting the restatements, changes in plan language, increases in contribution limits. The IRS and the government, they're constantly writing new rules and new regulations. So that needs to be reflected in your 401k plan documents. And you know, we do all kinds of free trainings and lifetime support and, you know, fun stuff for you to be able to actually meet other investors, and we have networking events and all that good stuff. Okay, so pricing. For a solo 401k, our setup fee is $399. The annual maintenance fee is $99 per year. That includes everything, all of the document updates, amendments, restatements, changes in plan language, all that stuff. We collect the first year up front, so the total to begin for a solo 401k is $498. If you sign up for a solo 401k, let this be a business expense. Your business is establishing a retirement plan, so you can write that off. Don't use 401k money to pay for it. That money is special, it's tax deferred. Use a business or a personal credit card. Let that be a deduction or a write-off for your business. The checkbook IRA is more expensive. It has more moving parts. There's a $995 setup fee and $325 in filings. If you qualify for the solo 401k, it is more awesome. I know that most companies don't usually tell you to go with the cheaper option, but it's also less work for our team too. So we want to make sure that you have the plan that is the simplest, that's the most elegant. I like to think about retirement plans on a spectrum of evolution. And the solo 401k, quite frankly, is just, it's the most evolved retirement plan. You know, investors have been using IRA LLCs since 1989. The solo 401k just came into existence in 2006. So it's most evolved, it has more features, and therefore it can be cheaper and simpler to maintain. But you have to qualify. So if you don't qualify for a solo 401k, all your money is in a Roth IRA, you have no business, you have a business with full-time employees, you don't qualify, then you should still consider the IRA LLC. It is an excellent alternative for people that don't qualify. Another interesting class of people that don't qualify is we have a lot of clients that are on H-1B visas, work visas. They're not allowed to have their own small business as part of the conditions of the work visa, but they have money that they want to be able to leverage into deals. The IRA LLC is a really good option for them. And again, I want you to be thinking about this not just for your own personal retirement fund leverage, but also if you're putting together deals, this is good for you to be thinking about for the way that you can communicate this to your investors as well. So if somebody comes to you and says, I want to use my IRA, my 401k to invest in your deal, they can. That's awesome. If you ultimately find out they don't qualify for a solo 401k, they have no business, something like that, it's nice to know that the IRA LLC can be a backup. So here's all my contact info. Feel free to take a screenshot. I can put it into the chat as well. I'm going to stop sharing my screen. That way I can jump into some questions. Let's see if that worked. Hold on.
Great.
Okay. Hello. Now, let me see. In the chat. Okay.
I have a question.
Yes.
So if someone used a 401k or their IRA to be an LP on a deal,
Yeah.
can they use their personal funds to be a GP on the same deal?
No. That would be a prohibited transaction. No double dipping. So if you're a GP, and then you need to find another deal for your 401k or IRA to be an LP on. And I know you're like, Rachel, but my deal is awesome. That's why I want to use my own 401k to invest in my own deal. I agree with you. The IRS is crazy.
Even if they use an IRA where the funds are going right back to that IRA account, so they're not really touching it. So
the IRS is the worst. So there's this section in the Internal Revenue Code. I know you did not expect to have a tax lesson with Rachel, but there's this section in the Internal Revenue Code called 4975 about prohibited transactions. There are 8 different types of prohibited transactions. This one would be considered 2, self-dealing and a conflict of interest. So you have to remember that the IRS doesn't write these rules for normal people like us. They're writing them for like the Jeff Bezoses of the world, where they don't want Jeff Bezos to be able to double dip in a deal. So for us, we can't invest retirement funds where we would personally benefit. That's what the IRS wants to avoid. Again, it's dumb. It makes no sense because of course you should be able to personally benefit so you're not dependent on the government for their services as a senior citizen. But we have to suspend reality when we're thinking about the IRS. You cannot personally benefit from your 401k or IRA's involvement in a deal. If you're the GP, you're personally benefiting.
Okay, so here go another one. So if I use my IRA or my 401k to invest in the deal as an LP, right? Can I now develop an LLC, separate LLC, to invest as a GP?
You still own the LLC though, so you're a common denominator of ownership.
Even if I'm not the manager, I'm just a member of the LLC?
Because you still own it.
Okay.
I know, I'm telling you, I'm used to the real estate people with the creative stuff, but it's what the IRS looks at is ownership. That's what they're looking at, because ultimately as the member of the LLC, you have ownership, so you could take owner draws, so you would be personally benefiting from that LLC's involvement.
So I have a follow-up question on that. So what if the 401k is just like one person's name, right? Like, for example, it's my 401k, it's my name. And the other LLC, it has two partners. And the other partner could invest from there, or could be GP for that deal. Would that be a conflict of interest too?
You also have ownership in the LLC that's the GP?
Because the company that's gonna go, the LLC that's gonna go in as GP, that has two partners.
But
So it
you're
could
one
be
of the
50-50
partners?
partners, yes.
It's possible. You would need to look at your ownership percentage. If you own 50% or more, it's probably a prohibited transaction. If you own 10, 15%, it may be possible, but you still want to get legal counsel to sign off on that. Anytime you're involved, which means your social security number is somewhere on the GP docs, right? Through the LLC. If someone looks at the chain of ownership, they're going to see you as the ultimate taxpayer, as a responsible or a beneficial owner, an indirect or direct beneficial owner. So if you only own a small percentage of that LLC that's being the GP, it may be possible, but you would need to talk to legal counsel to see what the threshold is. It might be 10%.
I have a question for you, if you don't mind.
Please.
Oh, okay. So I have a traditional 401k through my company, the job my W-2 job, and I created a self-directed brokerage account so I can have more control over the investments that I make. So the program was with Wells Fargo. I was able to invest in various stocks. It recently converted to Fidelity Net Benefits, and now I can't even invest in anything anymore. I mean, even the stocks that I currently own, I could sell, but I can't, invest in anything. So is there any way, I think I know the answer to this question, but do you know of any way that, am I bound to that company 401k while I'm still with the company? Do I have to be separated? Do I have to be separated? Yeah.
It really depends. So you kind of have to split your brain when you're thinking about this stuff, because for most company 401k plans, they're not really meant to benefit you. They say that they are, but they're not really meant to benefit you. There's usually a company, like a big plan administrator or record keeper, that makes a lot of fees on your money. So with a checkbook control or a solo 401k, it's just you. You're the only one handling your money. You're probably not going to defraud yourself. So that's why you don't have to charge yourself a bunch of, administration fees. You just don't. It may be possible for you to get some money out of your current employer 401k. The magic words to ask HR: partial in-service distribution. I'll repeat that. Partial in-service distribution. They can say no, because they can write into the plan documents that you can't have any of your money until after you've vested a certain number of years or you separate from service from the company. But sometimes if you say those words to HR, they'll go, oh no, he knows what he's talking about. And then magically they find that you are allowed to have some of your money. Whereas if you just said, can I do a distribution? They would tell you no, because you don't know what to ask for the right thing. So that's what I would ask them. Just be emotionally ready that they can say no.
And if they say no, I'm going to quit.
And then, well, it's funny that you say that, because we've kind of like coined this little phrase over the years: quit your job to save your retirement. where some people do that. I mean, if I know someone that's worked the corporate job for 20, 30 years, they have $500,000 in a 401k and they're seeing it being, invested in this fabulous basket of 3 mutual funds, like that's not really doing anything for people. So not legal advice, of course, I'm not telling you to quit your job, but you got to do a cost benefit analysis on stuff.
Thank you.
So, okay, there's a couple of questions we'll get to in the chat, and then we can also open it up for the roundtable. So Linda said, what's the maximum yearly for a Roth IRA LLC? It's just like a normal Roth IRA. So $6,000 in contributions, $7,000 if you're age 50 or older. Same deal there. Okay, Ray says, what are the differences between a solo 401k and an EQRP? I know you already know this one, but it's a good one. So EQRP with, I think it's called Total Control Financial, and Damien, great guy, really smart. EQRP is a marketing term for a solo 401k. That's what it is. So, and I like Damien, he's really smart. He's an excellent speaker, but that's what it is. QRP stands for Qualified Retirement Plan. Guess what a solo 401k is? It's a qualified retirement plan. So it's the same thing, literally. There's no special tax code. They call it a 401k because it lives in section 401, subsection K of the Internal Revenue Code. I told you guys I was going to be the tax nerd. So that's literally where it lives. It's called a qualified retirement plan. Why? Because it's qualified. What makes it qualified? You have a sponsoring business. That's what makes you qualified, which brings me to another question. Well, Rachel, what if I stop working in my small business? What if I shut down my small business? Guess what? Your plan's not qualified anymore because there's no sponsoring business anymore. So keep your business rolling on some level to keep that 401k rolling as well. But really the only difference between the solo 401k and the QRP from a legal perspective is it's a marketing term, and that's just a way to describe it. E, I think, stands for electronic qualified retirement plan. The solo 401k also has its own online platform, so you could also call it an electronic qualified retirement plan, and you can do stuff online the same way. So can you roll over a Roth 401k? This is from Patrick. Can you roll over a Roth 401k into a Roth individual 401k? Yes, absolutely. No problem. Brady says, does the 401k owe taxes if you invest in a property that has debt like a syndication? Excellent question. No, it does not. Another check mark in the solo 401k versus IRA LLC column.
You bit tax.
And like I said, IRA LLCs are great. They're not to be dismissed. If you don't qualify for a solo 401k and you have a deal you want to invest in, or you're a cap raiser and you have investors, it's not to be ignored. It's just not as awesome as a solo 401k. And here's another reason why. When a retirement plan invests in debt leveraged real estate, we use financing, right? You get a mortgage. That investor retirement plan is subject to pay taxes. But Rachel, how? Why? It's a retirement plan. I know the IRS is the worst. If you invest in a syndication as an LP with an IRA or an IRA LLC, you will pay taxes on some of the money. It's not a deal breaker. It's not the end of the world. It's on the leveraged portion of the deal. It's a small amount, but it's still there. The solo 401k is exempt from that tax. So Winston, let's say you and I are LPs in the same deal. You invest with a solo 401k, I invest with an IRA LLC. I have a tax return, you don't. The government takes some of my money in taxes from my distributions, not from yours. So if you do that cost benefit analysis over time, you're keeping more of the dividends and more of the money because you invested through a solo 401k than I would with an IRA, even though we're both investing with retirement plans. So there's still those kind of intricacies and little details. And that's why I keep coming back to the solo 401k as tending to be more awesome.
Okay. I have another question.
Yeah.
If I enter a deal with a 401k, can I exit the deal with a 1031?
Well, you don't have to. So The reason, so 1031s are there to avoid cap gains, right? To avoid paying capital gains taxes. So you're constantly rolling the investment into something else to defer those capital gains. With a solo 401k or an IRA LLC, you don't have to 1031. You can simply exit the deal because you're already in a tax deferred structure. Tax deferred structures don't pay capital gains taxes. So similarly, if you jumped on the, Bitcoin bandwagon, lots of the crypto traders ask me the same thing. What if I am, buying and selling crypto and doing day trading or even stock trading? They're not exposed to cap gains because they're investing with a 401k. Similarly, if you buy a single family, get into a syndication and exit the deal, you're not subject to cap gains because you invested with a tax deferred structure.
Okay. Thank you.
Can I ask you a question, Rachel?
Sure, Robert.
I started a QRP some years ago. I was looking into the tax lien industry, tax deeds. They really focus on starting QRPs. It's excellent for the investing they do. But I haven't deposited because it requires to put money into my the QRP, the account, the business account. Haven't touched it. I haven't really used it. Would that be still active? Do I need to? Because it was even difficult getting it through a bank. A lot of banks not familiar, but I finally found one some years back that was able to set up my QRP. I haven't used it. How would I go about should I just contact them to see if it's still active?
Well, I have a few questions. So remember, a QRP requires a sponsoring business. So is the sponsoring business still active?
Yes, my own business.
Perfect. Who has the QRP?
PNC Bank.
Did they write the QRP or did they just open the bank account for the QRP?
They opened the bank account for the QRP, and then the tax lien association I was involved with, they were the
plan provider?
Yes.
Okay. And I know this all seems like I'm going nowhere, but I promise I'm going somewhere. What year did you set that up?
Sure, I have to look at my paperwork. Probably a good 3 to 4 years ago, maybe 15 or 16, maybe 5 years.
Okay.
I just never got involved with investing.
Have you been paying them anything or gotten any paperwork from them on an ongoing basis?
No. Now I remember I kind of took the money out of it because I wasn't using it. I set it up with the minimum amount, but I never went ahead and did that type of investing into tax deed properties.
Sure. So 2 things. Our solo 401k does not have a minimum investment because we're not a bank. So we can be agnostic. You can open bank accounts anywhere, brokerage accounts anywhere. We have a couple of banks that we train. They make it a lot easier to open bank accounts because they know what you're asking for. They have dedicated solo 401k departments. But technically you can go anywhere because it's just a bank account, it's just a brokerage account. I personally have multiple bank accounts connected to the 401k. I have a Schwab brokerage account. I have crypto exchange accounts in addition to all of my real estate investments. So you can kind of think about the 401k like an umbrella, and you can have unlimited depository and investment accounts underneath it. The reason why I was asking about the paperwork is, nerd alert, the IRS goes on a 6-year cycle of document stuff. So every year, this is the way the government works. And I know that there's some of you that are ex-military, so you'll understand this as well. They add on layers of stuff until it becomes too much, and then they start all over again. And then they add on layers of stuff until it becomes too much, and then they start all over again. So this happens every 6 years with retirement plans, with 401ks. They add amendments. They change the plan language. And then at the end of the 6 years, they do what's called a restatement. The last restatement happened in 2016. So that's why I was asking what year, because if you had said, well, I set it up in 2014, I've done nothing since then, you would have to bring your plan into compliance before you could start using it again, which is just paperwork, and you throw $500 at the IRS. It's pretty straightforward, but you would have to do it. If you set it up in 2016, 2017, after that restatement, you're probably fine.
Okay.
I'll be done soon.
All right. Thanks a lot for your advice.
Sure. And I know this stuff can be kind of a brain melter. Retirement accounts are weird and confusing, and there's a lot of moving parts. So if you want to dig into your situation, just reach out to us and we can kind of talk through the specifics of your situation. Okay, so love this question, Ray. Thank you. So Ray said, can my solo 401k lend me money if I want to invest outside of the 401k? If yes, how does it work? Yes. So yes, and sort of. Your 401k can't directly lend you money. Because just like we were talking about for you, Winston, that would be self-dealing, right? Your 401k can't invest in a business that you own. Your 401k can't just lend you money. Robert, you're a lender. Your 401k can't lend money to you if you have personal money you want to put into a deal. But your solo 401k is just a normal 401k shrunk down small. So if you have a normal corporate 401k, then you have probably something called a loan that you can take from your 401k at work. The solo 401k is identical. So you can take 50% or 50,000, whichever's less, out of the solo 401k. It's tax-free. You don't pay taxes on that distribution. It's a tax-free loan. And then you have 5 years to put the money back. Your solo 401k earns 100% of the interest. You're just paying the principal plus interest right into your 401k bank account. So that would be how you would be able, if you have startup capital you need for a deal, or you just need funding, then you can take a loan from your 401k to yourself and then pay yourself back.
But you can wait till the 5th year and pay all of it back.
No, the IRS requires payments as infrequently as quarterly. So you only have to pay them 4 times a year, but you do have to pay them at least quarterly. I think they used to let you do just one lump sum, but for the last 5 years or so, at least, they say you have to be paying it back at least quarterly. And you can't just do interest-only payments. They have to be what they call substantial and equal payments. So chunk down whatever your monthly would be, triple it, and then that's your quarterly repayment.
So if they use a solo 401k to invest in a new development deal, how do you make quarterly payments?
Well, you're not, so there's a distinction, and I'm a total word nerd when it comes to this stuff. So there's a difference between taking a loan from the 401k to yourself and then investing that money, and then just having your 401k invest in a deal. If your 401k invests in a new development, you don't have to pay anything back because it's just the 401k investing. Those quarterly repayments come from, if you've got this chunk of money in the 401k, you take a loan, you take the money out, you have to start putting money back. So the IRS basically says, look, you have to be responsible to figure out how you're going to make those payments back. Otherwise, they consider it a deemed distribution. It basically means they're going to charge you taxes like it was a withdrawal.
Okay, so on a new development, how much time do I have before I get a red flag?
Well, are you talking about the 401k being an investor, or are you talking about taking the loan so that you personally, Winston, the human being, are the investor?
No, just a straight investment to the deal, not to me.
There's no time horizon. So we've got 401k clients that invest in like VC deals, startup capital. Sometimes they don't have an exit for 10 years. Totally fine.
Okay.
Yeah, there's no time frame from when your investment needs to start yielding returns. If there was, people would never be able to get anything done. The IRS can't tell you, this is an investment they have to start paying you in X number of times. It just wouldn't work that way, in the free market. So you can make any investment that you as the plan trustee believe to be a good investment for the benefit of the 401k plan. So if that's a new development, then, and that's not going to maybe have a deal or an exit or start cash flowing for a few years, then that's fine if you've done due diligence as the 401k trustee.
Okay.
I have a question for you, Rachel.
Sure. What's up, Brian?
You had mentioned about employees, part-time, full-time. As far as this is concerned, what are the rules as far as hours worked?
Full-time is considered 1,000 hours or more per year. So if you have employees that work 1,000 hours or more, which is about 20 hours a week.
Yeah.
So, because if you do 20 hours a week, 52 weeks, it's not that much. And then there's this new law that basically says if you have employees who work 500 hours a year, the same employee for 3 consecutive years, then that kills the qualification for the solo 401k as well. So the solo 401k is it's really created for owner-only businesses. If you start to have employees in your business, you really need to do some calculations, work with your tax professional, see how many hours these people are working for you. If they're independent contractors, that's fine because they're not employees. I'm specifically talking about people where your company is issuing them a W-2. Because remember, 401ks, they are employee benefit plans. That's what a 401k is. It exists for the benefit of the employees. The thing that's awesome about a solo 401k is you and maybe you and your spouse are the only employees. So you get all the benefits. The issue comes if there's other people in your business that you have to start sharing the benefits with. That's when the amounts drop, the investments get more boring because there's all these other people you now have to deal with.
What if I have a business that has no employees, but my wife has a business that's running into the issue you're talking about? Could I have a 401k on my own?
Yeah, there's a workaround. How much does she own of the business that has full-time W-2 employees?
She's a sole proprietor, so she owns 100% of it.
Okay, so you can have a solo 401k. And are you an officer or director or anything in her business?
We just formed an LLC for that, I believe. I'm a partner.
So if you are, then that's going to kill your qualification for the solo 401k. If your spouse has a business with employees,
yeah,
you can still have a 401k totally separate. She can have $0 in your 401k and you can have 0 involvement in her business. You can't cross-contaminate.
Okay. All right, thank you.
Yeah, sure.
Rachel, quick follow-up question there.
Yeah, go for it.
So let's say you have the I-401k with just yourself or you and a spouse, and then you add on employees in a later year. What happens to then your I-401k?
So it depends. It depends on what you're invested in. If you are just invested in something like stocks and bonds, then you can probably roll over to a corporate 401k plan that's going to now provide for your employees. If you have things like real estate investments in your individual 401k, then those probably need to roll into something like an IRA LLC. And then you would decide if you're going to establish a company retirement plan for your employee benefit. But you don't want to get rid of those individual or those alternative assets, but they can't go into a corporate 401k plan. So they would have to be rolled into something like a checkbook IRA.
Got it. Thank you.
Yeah, sure. And Brendan said, are solo 401k distributions taxed as regular income? Yes. If you do a normal distribution from a 401k, a solo 401k, it's just like if you did it from your workplace 401k. So let's say you're going to take out 10 grand as a distribution. Depending on your age, there may or may not be early withdrawal penalties. And then the IRS just adds that 10 grand onto your taxable income for the year.
At a certain age, does that time out, like 59 and a half or anything like that?
If you're over age 59 and a half, you're not subject to the extra 10% early withdrawal penalty, but the IRS is always going to get their cut. If you took the tax deduction, putting money into a retirement plan, they're going to take a piece of it when you take it out.
Gotcha.
What do they say? Nothing is certain but death and taxes.
True. Thanks.
But my mentor said, you can hate taxes and love the tax code. So, it's like a puzzle trying to find the legal loopholes that are there that let you be in charge of your own money and put a lot of money away. And then of course there's advanced tax structures on, how to minimize taxes and things like that.
I have one more question for you. Sorry, I have one more question for you regarding the K1. So with the 401k, the K1 does not matter, right? If you get the K1 depreciation, you will never be able to use that, right?
So are you talking about like with depreciation, or are you talking about just you have to file on a tax return?
Yeah, depreciation. You know how you can take the advantage of the K1 with your regular income, you cannot do that with 401k, or can you?
No, you can't, but you don't need to, because there's no taxes. Right. So people take depreciation and losses because they're trying to lower the amount of taxes that they owe. Your 401k doesn't owe any taxes in the first place. So the depreciation, doesn't really do anything because you're not trying to lower any taxes because there are no taxes.
Thank you.
Sure.
I have a follow-up, Rachel.
Sure,
The
Robert.
amounts you were talking about, 64,000 individual, 128 couple. What age would that be taxed at if you touched that in the
So with
those dollar
contribution,
amounts?
yeah, so for contributions, if you're under age 50, then the max that you can put in is 58,000 per person. If you're age 50 or older, then you get something called catch-up contributions, which is an extra 6,500 bucks. So you can put in 64,500.
That's the max per year you can put in.
Based on your income. So this is, again, the IRS, you know, push me, pull you that they do. The more you make, the more you can contribute, and the more you're going to owe in self-employment taxes. So there's no free lunch, right, from the IRS. So you need to work closely with your tax professional because hooray, you're making more money. Boo, now you're paying more taxes. Hooray, now you can put more into a tax deductible structure. Anytime you take money out of your retirement plan, the IRS is going to take a piece of it. You have to start taking money out at age 72 and a half or 72. You have to. They make you because they want their money, right? So they're going to make you start taking that. But if you're under that age, then distributions are at will. You can choose to take money out or not. It's up to you. I would say don't take the money out. If you need the cash, do something like the loan.
Okay. Thanks a lot.
I think we're over time, Rachel. You killed it.
Yeah.
That was good. I know it's a little bit earlier in your neck of the woods, but you still put in some
Keep
overtime.
rolling. No, just kidding. I know this is a bit of a brain melter, so thank you for having me, Ray. You have an awesome group. Really good questions.
Yeah.